Hi guys, this is Investing with JYK, and today we'll look into Tesla's cash flow. And um, I'm not going to show you the entire process of the research. You're just gonna, if you want to verify the numbers, you can go ahead and do so. And I'm just gonna show some of the numbers, and then some of them is gonna say that I did the research, and you kind of take my words for it. Okay. So just to review what Tesla did over these years, I tried to find out if their warranty cost was changing over the years, and so their warranty cost definitely was reducing. Right, so it peaked in 2013. I think that's when it's like at the end of life for roadsters. Roadsters typically have 3 to 4 year uh, 3 to 4 year warranties, and then that is said in the 2012 annual report. And 2012 is when they start mass introducing the Model S's. So as a new car, they probably had a lot of issues, and so that's when it peaked. And it has been going down ever since. In terms of actual costs incurred in that year. So the way I calculated this is just I added all the cars up that's still running, that's still under warranty, and that's a number. So okay, yeah, so that's that. So as a side effect, I was able to get the number of cars that was sold in that year, and then there was also like 2,000 roadsters that they sold at the beginning. And I didn't check the annual reports before that, so I'm just gonna put it there. Assume they were like 1.5 years old going into 2012. Actually, 2 years old, I think. That was the number I came up with. Yeah, so their delivery went from 2,000 to 100,000. So kudos to them. And okay, so now let's get into cash flow. I listed out all their debts, so you can see these debts. I think it was just somewhere down here, fairly close to the asset, the balance sheet there. All right, here we go. These are all the debts, so I put them over here. And for some of them, they have floating rates. I basically assumed the middle number. For LIBOR, I assumed LIBOR is actually the overnight LIBOR. It's not going to be true, but it's the cheapest LIBOR I can find. They didn't specify which one it is, and I don't know what the convention is. So I just assumed it to be the cheapest one. So I put 1.7 there. And yeah, so okay, so what I did was I added up what they have to pay in 2018. So to pay 780 million in 2019, at least $2.1 billion. Why I say at least? Because a lot of those are almost like a pay-as-you-go kind of debt. So you got the term loan. You got a couple of term loans here. This guy, you got a portion of it it's due in 2018, and a portion of it will be due in 2019. And similarly, even the warehouse agreement, a portion of it will be due in 2019 as well. I just assume they're not. So that's really the best case scenario. And the capex is the capex number for this year, and this one you can see it somewhere in here. Where's my cash flow? There you go. That's a number. So that's how much money they went for spending. And they also talked about what they're going to spend next year. So capital expenditure, and you see there was there. Capital expenditure in 2018 are projected to be slightly more than 2017. So I kind of came up with different scenarios. Just remember, it's going to be at least as much as 2017. And the other interesting thing is, if you look at the cash flow statement, consolidated statement of cash flows. God. Compre. Such is life. Let's go to somewhere around here. Okay, here. You can see the main contributor to not so much negative cash flow is really in terms of operations, is that we didn't account for this, so that's not going to change in this case either. And this one, the stock-based compensation, so this non-cash event, it's almost like issuing stock, so we don't care. That's not going to have an effect this year either. And inventory write-downs, we don't care. That's, I mean, it's bad, but not in cash events. So these things are just basically non-cash events. And now the interesting thing is the change in operating assets. So essentially the like payables and receivables, inventory, and all that stuff, right? You can see inventory went down a little bit. Actually, increased a little bit. So they increased a tiny little bit, and then this lease basically keeps increasing, but that's actually okay. They will borrow money to cover the lease, and then basically the lessee would lessee, I don't know, and the person that leased the vehicle would essentially pay for these loans. So let's ignore that. And so basically it's not gonna have much of a change. And then you got the prepaid. We don't, tiny numbers, 17 million. Well, it's big, but in grand scheme of things, it's tiny, so we ignore that. Account payable increased by close to $400 million, and then this account payable and accrued liabilities, that's large. Now, and then you got a pretty large amount, a sizable amount of customer deposits, and this one we don't care. It's really not that important. And okay, so let's look at this number. So you see that the payable increased a lot. That just means they're owing a lot of money to their suppliers. So people like Samsung, or people that make their seats and whatnot. And this number potentially can increase, but how far can it increase? So I did a little calculation. So the account payable and other liabilities, in this case they say like once it's invoiced, basically a lot of the accrued liabilities is uninvoiced but liability. So basically, they know they will have to pay these suppliers, but the suppliers haven't billed them yet. And that in 2017 is this number. That's a total, right? So this is the change. This is a total. So they got like $4 billion of accounts payable. So they have to pay their suppliers $4 billion, which is 35% of revenue. You say, oh, it looks really high. Yeah, it does look really high. But 2016 was even higher. So you're like, okay, so what is a normal number? I checked Ford around here. I checked Ford. So Ford, in terms of, if you look at their asset, the payables, I checked their other liabilities. They're not really, they account things differently from Tesla, which you probably could have told from my previous video. So this one really isn't the same as suppliers. It's a bunch of, I forgot what, but it wasn't like suppliers. So I basically divided this number by the automotive revenue. Right? And then bear in mind, Ford also has a financing branch. I kind of just said, okay, you know, tiny revenues, finance your cost is going to be rolled into the automotive part. So that they had 15% of their revenue in payables. So okay, so I thought, okay, so we could either maintain, we could either think about, you know, 40%, say they could go back up to close to 2016 levels, 40%, or maybe the more realistically, they may be looking at, you know, maybe not 15, say 30%. And so I did a revenue projection too. So the way I did the revenue projections, I pegged the Model 3 at $50,000. So these are thousands. These are all $1,000. And they're gonna sell 60,000 cars because Elon Musk promised, yeah, 5,000 cars per week. Obviously, we are actually more than a quarter into the year, and they haven't done 5,000. I'm going to take their words, say, okay, over the year, they're going to average out 5,000. I'm being optimistic with these guys. Right, so that is their new revenue, and they're not increasing their S and X sales. They are plateauing anyways, if you pay attention in other areas, which I'm not going to get into here. And then here is the energies revenue. So I assume they're going to grow by 20%. And that will be the projected revenue. So if I say 40%, it's going to increase the difference between the new account payable and the old account payable is going to be the difference. And that is going to be $2 billion. If we assume 30%, which is like a decrease, the increase in payables is going to be $700 million. Okay, so we had those two scenarios. Obviously, you could have other scenarios where this really isn't 60, but really, the first quarter was like half, so you're really looking at minus 7,500. Right, so something like 52.5 thousand or something like that. Okay, so armed with these numbers, let's look at. I should really move this thing here. Yeah. So look at their numbers. So the cash flow for 2017 was negative 60 million. And if we use basically if the supplier is going to finance Tesla at 40% of the revenue, you end up with the 200 million here, sorry, 2 billion here. And then the deferred revenue is going to increase. I'm going to assume the deferred revenue will increase. It's deferred revenue is your lease, so I think it's reasonable to assume that the leases, they will actually get more money from the leases as they lease more cars, including the Model 3s. So I put 100 million there, and then the Model 3's deposit will get used, assuming 60,000 cars, and then each one consumes $1,000 cash, so that's 60 million. Their capex, they said they were going to be at least as much. I'm just going to say, okay, it's just going to be as much. So that is going to be at $4.4 billion, and debt payoff, so that I computed everything that's due in 2018, you're going to have $760 million. These are all in thousands, by the way. And then I'm going to assume that Model 3 will bring in them, 10K cash for every car sold. So that's also very optimistic. They initially said it's going to be a 35,000 cars, so setting that number clearly is not going to be 10K. It's probably going to be something like 3K or whatever. But assuming they sell it at like 45K plus, and then they are able to make Model 3 at 35, which I highly doubt, because the Bolt costs 28,000 to build, and then Bolt is a much shittier car than Model 3. And Bolt has a smaller battery. Bolt uses a bunch of parts from Sonic, so the parts are all old. So Bolt is a really cheap car to make, and that's 28,000. Model 3 is bigger, faster, more battery, more advanced in better materials, everything, and new parts. It simply cannot be even close to 30. So I'm saying that they're gonna make 10K. So okay, inventory, there's no increase in inventory. Okay. Actually, this is gonna be a negative number. D61, D64. Wait, what did I do? That doesn't make sense. This number is supposed to change. D55 to D62. Oh. Yes. Okay. And then inventory. So assuming there's no inventory change, the projected cash flow, if we sum all these up, it's going to be negative $2.2 billion. Their current cash is $3 billion. I think somewhere in here, $3.3 billion. And their total revolver that they haven't used, I sum it all up in here. You've seen it in the previous content. I've added them up. They have something like $1.6 billion in credit line, so they will be able to sustain that, and then have $2.8 billion left. Now, look at this. They have another $2.1 billion due in 2019. So I wonder. So 2019 they will get screwed. But assuming they don't get even more money for their Model 3, and the 10K also doesn't account for any warranty costs and all that stuff, so those will come up. So I also came up with a slightly more realistic scenario where the account payable becomes 30% of the revenue, which means the increase is only going to be 700 million, and the deferred revenue, let's assume these are the same, capex is 10% more. They said slightly more, 10% than 2017, so $4.8 billion. That payoff doesn't change, and instead of bringing home 8K in cash, Model 3 will only bring in 8K in cash, because you gotta repair them, and they probably actually don't have that high of a margin. And inventory would increase by a significant amount, like 60%. And why is that? So I looked at their previous introduction of their Model X, and every time they get a new SKU, essentially, you have to expand your inventory, because you need the same amount of inventory to service the S's, the X's, and now in addition the Model 3. So I checked their previous number, which is 2015. That's 2016 is when Model X got introduced. So if we compare, right, I wrote that the increase was quite high, from 12 billion to 20 billion, and that number came from 1 billion to 2 billion. Yeah, 1.2 billion to 2 billion. I'm gonna assume there's gonna be another 60% increase in their inventory, and that comes out to around $1.2 billion. So their projected cash flow for 2018 is now negative $5.6 billion, and they will end the year with negative $500 million, and that's the definition of bankruptcy. So they will either have to do a capital raise or get some more debt. Now the debt market is really not being very kind to Tesla at the moment, and I think their debt is now like 6 or 7%. Tesla debt bond rate, bond yield. Yeah, I think it's somewhere here. Yes, yield to maturity is now 7%, basically. Well, today it actually just got better, but it was crazy. This is a 2021. Actually, there's a Tesla 2025. That's the biggest debt they have. You can see around here, 2025. Yeah, this guy. That is actually the biggest debt they have. And that guy, bonds, 159. What the hell? Excuse me. Oh, actually, I can't find it. But it was 5.3. Yeah, bond yield 5.3. Bond price. That might be something. Yield to maturity. Do they have yield to maturity? Oh god, useless. Anyways, it was something around, I remember it was something around 7% it got to. So their debt will become very expensive. They'll put even more interest expense on their income statement, well, or loss statement in their case. But just look at these numbers. In 2018 alone, from my projection, their total interest expense is $300 million. If they don't raise any more debts, and then they will pay off some debts in 2018, their 2019 debt level interest payment will be still $300 million. And that's a huge number, because if you compare it against their revenue, well, actually, you can't really compare it against the revenue. You probably should compare it against their gross profit. But let's see. Compare against their revenue. It's 3% of their revenue, but their gross margin was something like 19%. So this divided by 0.19 is is 15% of their gross margin, a gross profit gone in profit in interest. I just find this crazy. And then if they do raise more debt, say they raise more debt to cover another year of operation, probably around $4 billion at 7%, that's another $200 million, $280 million. That's $600 million in interest expense, and that these are all cash items, mind you. So that would then take up something like, imagine this was something like plus 280, and if we do divide by the revenue, you get and then divide by 0.19, quarter. So a quarter of their gross profit goes in interest payment. Actually, that number might be wrong, because I was actually, let's just be very sure on their gross. Never mind. This video is already too long. You get the picture. So I think Tesla will need a capital raise this year, most likely, and unless somehow they're able to be super frugal and not increase inventory and make the suppliers give them even more credit, but these have to pay back later. Just for 18, if they do those two things, maybe they can get through 18, but they have to do capital raise. I think probably summer, slightly late summer, August-ish. And if they're able to raise a lot of equity, like $4 billion plus, or maybe even $10 billion, then there is no crisis. If they couldn't, so if they need to raise more debt, that's potentially the trigger at which point I might start shorting Tesla again. Yeah, thanks for listening, and next time we may discuss why debt is especially bad for Tesla.